Let's get this presentation started. My name is Andrew Keene. I will be giving today's presentation. Today is Floor Trader's Secret, Confessions of a Professional Options Trader. Today, my name is Andrew Keene. I'll be your presenter today. Past performance is not indicative of future results. Very, very important to put that in there. All right. So a little history about myself. My name is Andrew Keene. I was a floor trader at the Chicago Board Options Exchange for about a decade. During that run, I worked for Bodie Capital Management, and then Ed Tilley, who is actually the CEO of the CBOE, backed me with his own money for about 2 to 3 years. I never know how long he actually backed me for. And then he took a position at the CBOE where he couldn't back me anymore. So I traded down at the Chicago Board Options Exchange for a very, very long time. And I made about $5 million in my trading career. You know, that's just gains minus losses is not just gains. A lot of people, you know, when they trade, they make money and then they lose a bunch of it back. But that's my net P&L, close to around that $5 million mark. And what I'm going to teach you guys today is how I made all my money. It's called institutional order flow in the option market. Watching the biggest traders in the world place and allocate capital to trades based on speculation to the upside and insider information. So very, very cool presentation today. Active trader, I trade futures, I trade Forex, I trade stocks, I trade commodities, but my bread and butter more than anything else is trading unusual option activity. That is how I've kind of made my name for myself. I've done so many hits on CNBC, Bloomberg, Fox Business, talking about unusual option activity. If you guys watch CNBC Halftime Report with the Nigerian brothers, they talk about a very, very similar format, which is institutional order flow in the option market. Okay, institutional order flow in the option market. And I'm going to teach you guys why I think this is the best way to trade, and I continue to trade for like this. I've been now trading for about 15 years, and I don't really tweak and shift my strategy very much. I just continue to do what works, and institutional order flow in the option market is what works the best for me. So I'm going to teach you guys something new that you've probably never seen before. I'm going to teach you guys a proprietary-based trading plan, how you can look at a trade and know if it's speculation or hedge, so you can use this in your trading. Little risk disclaimer, we have to put this in every single webinar. Day trading, short-term trading, and option trading, and futures trading for that matter, are extremely risky undertaking. They're generally not appropriate to someone with little capital, low or no trading experience, or a low tolerance of risk. Never execute a trade unless you're willing to prepare to lose your entire investment. All trading involves serious risk. As Hubert Center, my mentor, goes, you can lose all your money. Okay, so when you guys are trading, you know, good traders think about how much money they can make. I do not consider myself a good trader. I consider myself a great trader. I say, if I am wrong, how much money can I lose? So I'm not looking to see how much I can make. I want to know if I lose money, how much money can I lose? What's the most amount of money I can lose? This is something we're going to teach you guys in the boot camp. You can see the screen, but you can't hear anything. Sound is good. Okay, so sound is good here. So what I'm going to teach you guys is something called institutional order flow in the options market. The terminology is paper. So back in the day on the trading floor, a broker would come into the pit with an order in their hand, okay? And they would say, what is that order? What's the order? What's the order? What's the order? Okay? This is what the initiator wants to do. What happens then is they started calling it paper. Hey, what's in that piece of paper? Hey, what's in the piece of paper? It's a big secret of what someone wants to trade. We're talking about the biggest traders in the world, David Einhorn, Carl Icahn, Bill Ackman. These all are trading options. We'll teach you guys why stocks are dead. Futures are dead. Everybody is trading options, and you guys need to get aboard the option game. So basically, paper is an order from a hedge fund, mutual fund, retail bank, or big trader. I am watching institutional order flow from the biggest traders in the world, okay? A lot of you guys don't make money trading. I'll tell you why a lot of you guys don't make money trading. There's about 150 people here. That means only 15 of you make money, The reason you don't make money is you're looking at your own trades. Okay? I am not making up my own trades. What I'm doing is I'm looking for trades that other traders that are smarter than me are putting on. Let me repeat that. I am not coming up with my own trades. I look at trades from the biggest traders in the world and I mimic their positions. It's not a hard concept, and I'm here to teach you guys how you can do this yourself. So paper refers to an order from a hedge fund, mutual fund, retail bank, or a big trader. Who are the major players? Mutual funds, pension funds, biggest traders in the world. Why is paper important? If you guys have ever seen American Greed on CNBC, if you guys have ever seen Billions on, I think that's Showtime, talking about institutions trading on insider information. If you do not think that traders have insider information, then maybe you should go to a different webinar, because it's a fact that they are trading on insider information. Okay? But the OCC and the SEC doesn't have the manpower to go against everybody that is out there. And this is why this order flow continues to work and work very, very well, because they don't have the manpower to go and prosecute everybody. So why trade options? Options are a derivative of stock. They are not that complicated. They are not that hard to understand. Stocks can move a couple percent, 1%, 3%, 5%. That's not cool. That's not exciting. What I want to see are big moves. I want to see 20% moves, 50% moves, 100% moves. I'll show you guys examples today where an option moved 500% on only a couple percentage move in the stock. Okay? Because options are a derivative of stock. It is the right but not obligation to trade stock at a certain price by a certain expiration. So this is why everybody in the industry has shifted from trading stocks to trading options. Another reason there's a big industry shift out of stocks and into options is due to the fact that the margin requirements in stock is insane. I shorted 100 shares of Google the other day when I was trading, and my margin requirement was like $36,000. Well, I could have bought one put and had $800 of margin requirement. So that's another reason why the industry shift has gone like this. So let's talk about type side trade. Everybody makes options so complicated, so confusing, so complex. They're really, really not. There's only two types of options. There are calls and there are puts. An institution can either buy calls. Why would an institution buy calls? They're either buying calls as speculation to the upside or a hedge against a short stock position. If a trader sells calls, why are they selling calls? They are only selling calls for one of two reasons. They're selling calls against a long stock position, or they are selling calls to establish a short stock position. And throughout this presentation, I'm going to show you guys a proprietary-based trading plan, how you will know if they're doing it against a stock position or if they're doing it just for the outright option. Trader buys puts. Are they buying puts as protection against a long stock position, or are they buying puts as speculation to the downside? Trader sells puts. Are they selling puts to establish a long stock position at a lower level, or are they selling puts against a short stock position? So that's all, guys. There's only two types of options. There's calls and there's puts. Institution can either buy calls or they can sell calls. They can either buy puts or they can sell puts. Okay? The main thing we want to know is, are they doing it against a stock position? That is really, really important. Okay? Because we never know a trader's stock position. Okay? So does reading paper work 100% of the time? And I'll be completely honest and candid with you. The answer is no. if there is a strategy or philosophy that worked 100% of the time, a holy grail system, and someone gave you a webinar on it, I would say run for the hills. Okay? But the fact of the matter is I think I've been profitable 12 of the last 15 years trading this way, and I've made close to $5 million in my career, and I've taught, more importantly, about 50,000 students how to trade this way. And I've actually sold more educational courses on this topic than anything else. Because there's nobody out there that knows this topic as well as me. Because I've been trading like this every day, almost every day, for 15 years. Okay? So let's break down the order flow. And none of these have been back tested, but they're basically a generalization here or an idea of it. So if an institution buys calls, if I had to do a breakdown and say the percentage of times they are buying calls as speculation or percentage of times they're buying calls as a hedge, I would say they are buying calls 60% of the time to establish a long stock position. I would say 40% of the time they're buying calls against a short stock position or maybe a volatility play. Institution sells calls. I would say this is 50-50. And you say, hey, Kay, I've read every single book on options. How can selling calls actually be bullish? Well, a lot of times an institution will sell calls against a long stock position to create an extra dividend stream. Buying puts, okay, and this is something that's very important. We're going to teach you in the boot camp. 65-35. Bullish, not bearish. And you say, hey, Kay, that can't be right. How can 65% of the time an institution buys puts is bullish? Well, I'll tell you exactly why. The OCC and the SEC has gotten smarter. I actually got a call from a lawyer in LA, and he said, hey, I want to ask you questions about unusual option activity and about institution order flow. I said, give me a call tomorrow. And this is a lawyer, not to do with me, just he wanted information. And then you know what I told him the next day? Wait, why would I tell him anything I know? There's no reason I should ever tell him anything I know because I want to trade like this. If one day, hypothetically speaking, I can't trade like this, I'm going to be in a lot of trouble because this has been my bread and butter for 15 years. Okay? So I didn't even take the phone call. I told them that my lawyer told me not to take the phone call. There's no upside for me because I want the ability to trade like this. There are currently no dark pools in the option market. Okay? So that's why this trading works so well. So if they've gotten smarter in their old age, we all know the synthetic. Okay, so you can synthetically make a long call by buying puts and buying stock. Okay, so a synthetic long call is buying puts, buying stock, so that we know that actually buying puts could be bullish because they could have a stock position on against it. Then we have selling puts. Selling puts is a holy grail strategy. Well, not a holy grail, but 80-20. Most of the time they sell puts. They are just willing to establish a stock position under the market. Okay, so it's actually a bullish to neutral strategy. It's not exactly like the most bullish strategy, but it's a bullish to neutral strategy. Okay, so this is kind of the breakdown of everything they can do. So the first thing I'm going to teach you guys is a breakdown of everything an institution can do. Then we're going to look at examples of institutional order flow. Then I'm going to introduce you guys to my Oak Rivet trading plan, OCRBTTT. Okay, and you can use this in your everyday trading when you're looking at institutional order flow. So what kind of market does this work on? Okay, this kind of market works on any kind of market. However, as we saw the last slide, it is more geared to a bullish market. Okay, look at these percentages. So it's more geared to a bullish market. Okay, how has the market been over the last 8 years? We have been in an upward trend higher. So this works best in a bull market. Okay, does it work in a bear market? Yes, you're just going to take more activity in the puts than you are going to be in anything else. Okay? But this kind of trading strategy works on any kind of market. But it works better in a bull market. So the stock market has been in a complete bull market for the last 8 years. So this kind of strategy works great, guys, in this kind of market. It will work with a bear market. You're just going to have to shift your trading around in your strategies. So let's talk about the whales. Okay, this is the killer whales, and I'm just a small little fish under the whales. Okay, so you see here that this is the whale in the sea. Okay, these are the pension funds, the mutual funds that are allocating trades that they think will be profitable in the long run. AlphaShark's traders are just right under this. Okay, they're going to be trading 10,000 lots. They're going to be trading 20,000 lots. They're going to trade 100,000 lots. I'm not trading that much. I might trade a 10 lot. I might trade a 20 lot. Okay, but I just want to follow exactly what the mutual fund, pension fund, sovereign wealth fund is doing. Okay, so I'm just swimming underneath them. As you can see here, I have protection. Okay, they will scare all the big fish away, and I just want to be the school of fish underneath them. Okay, I used to be a very big trader, guys. Okay, I'll be completely honest. I am not that big of a trader anymore. I trade. I mean, I'll get up to 300 lot, but I used to trade 1,000 lot. A lot of my trades are 10 lots, 20 lots. I made $1,000 today, and I'm long 80 options. So I'm not that big of a trader anymore. I'm just with you guys underneath the sovereign wealth fund and the pension fund, just trying to trade a little bit. Maybe this whale trades a 10,000 lot. I go through the proprietary based trading plan. I look at it and I say, hey, maybe I want to take a trade. Maybe I'll take a 10 lot. Okay, nothing to bulk at, guys. If you guys can make $500 a day, okay, if you can make $500 a day, that is $132,000. That's not bad. Not bad at all. I think most of you guys here would take $132,000 trading, not having a boss, being able to come in and out whenever you want. Sounds pretty good to me, right? Don't have to listen to anybody. You can sit at home in your boxers or maybe your underwear, whatever if you're female, I guess I don't know what you'd be wearing. And then you have the institutional traders. So those are the big hedge funds. Okay, these are the big hedge funds. So these are the Carl Icahns. These are the David Einhorns. These are the Bill Ackmans. These are the Leon Coopermans. Okay, so these are the hedge funds. These are the sharks. So we have whales and then we have sharks. And I just want to be underneath them. Okay, so AlphaShark elite traders. By being able to see what more aggressive fish are doing, we can see opportunities to profit from them and mimic their position. Okay. So this is an example in RIG, rig. Okay. By the end of this presentation, you'll be able to look at this order and know how to dissect it and analyze it to a T. But let's look at this order in RIG. Okay. Every single one of these, they say a picture is worth 1,000 words, right? Well, an order is worth, maybe not 1,000 words, but maybe about 12 words. Okay. So this is a trade by a big trader. Institution buys 23,250 RIG April 6th. Okay, that's expiration. 10 calls for 28 cents. So let's bring up all the aspects of this trade. Okay, so the trade size, 23,250. We all know that one option is the right but not obligation to buy 100 shares of stock. So a 23,000 lot, okay, is the right but not obligation to buy 2.3 million shares of stock. Okay? So somebody's taking, somewhere in the world, no idea who this person is taking the right but obligation to buy 2.3 million shares of RIG by April 6th, so this is about a month ago, on the 10 strike for 28 cents. Okay? If we did the breakdown of the math, it's about a $600,000 bet. Okay? It's about a $600,000 bet. So the breakdown here, somebody somewhere in the world buys 23,000. In the private mentoring sessions, I will show you guys how you can get all these through Think or Swim. So they're buying the right but not obligation to buy the April 6th, 10 calls for 28 cents. It's about a $600,000 bet. You know, it's possible you like this trade. Maybe you take a 20 lot. Okay? If you took a 20 lot on these, let's say hypothetically you took 20 of these, as a beginner trader, let me not use yellow. So if you took a 20 lot, and let's say you took a 20 lot of these, and you used a 50% stop loss. Okay? So that would be $280 of risk. That $280 of risk would have turned into, because these went up to 75 cents, this would have turned into $1,500. How do you like them apples? About 600% returns on your risk. Okay? So this trade, you could have taken $280 of risk and turned it into $1,500. Okay? So what is the order process? Basically, the institution will create an order based on research, information, and analysis. They will then call up the broker. They will call Goldman. They'll call Citadel. They'll call Merrill. They'll call Morgan. And they'll quote-unquote shop the order. They will literally tell them, I have a customer who wants to buy 23,000 RIG calls. Okay? Then the brokerage will take the other side of the trade. Okay? So the broker will take the other side of the trade. Then the trade will be executed. Once it is executed, it is a public trade. So even if an institution is trading on insider information, if I'm trading on it, it's actually considered a public order. And the reason it's considered a public order is due to the fact that it is executed. Okay? So, simple and easy. This is the kind of orders that you'll see. I'm going to take you guys through my proprietary base trading plan so you know if that RIG trade was a good trade. I can look at those trades within about 30 seconds and know if it's a good trade. I will teach you guys how you know within a couple minutes if it's a good trade or not. So these trades will then get sent out, and I watch these trades all day long, and I allocate my own personal capital, okay, on these trades. Some trades I maybe allocate $500 of capital. Some trades I'll allocate $10,000 of capital, okay, because I always put my money where my mouth is on these trades. So we are watching the best trades in the world, okay. So these are the best traders in the world. Allocate, put money in real time, and this course will teach you how you can trade this better. No more guessing for trades, making up trades yourself. You just get to find the best traders and mimic their positions. There are no dark pools in the options market. That is a fact, okay? If you guys are trading stocks, futures, forex, good luck to you, okay? Because you can't watch institutional order flow. There's something called dark pools. There's something called icebergs, okay? You guys might not know what they are. You don't have to know what these are. But every single order is written down for the OCC and the SEC. So I get to see every single trade that goes across tape. In an average day, there's maybe 800 to 1,000 trades. I might take trades, allocate my capital on 2 trades a day. Maybe some days 6 trades in a day. Maybe some days like today, I didn't see anything worth allocating capital. I didn't take any unusual option activity trades. But there's no dark pools in the option market, guys. And this is so important because this is giving you an advantage over other traders, okay? You've tried things before in the past. Now try something new that you haven't traded before. You guys are all here today for one reason only. It's to make more money trading, okay? So try a new philosophy, try a new strategy that maybe you've never traded before. So, have you ever played the computer in chess? Maybe some of you have, maybe some of you haven't. If you play the computer in chess on expert level, I'll give you a clue. You will never, ever, ever win. Why will you never win? Because there's always one correct move. And that is very similar to trading futures, forex, stocks. Okay, there's literally always one move. I saw Gary's, what's his name? Who's the best chess player in the world? I saw the best Kasparov. Yeah, I saw Gary Kasparov. That's what it is. I saw Gary Kasparov beat 25 people in chess, one move at a time, just going around and around and around. Okay, so you guys, if you want to play the computer in chess, you're never going to win. This is very similar to trading stocks, futures, and forex. I'm sure a lot of you guys have been stopped out before. Like, oh, why did I get stopped out? Okay, the reason you got stopped out because the computer knows where to stop you out. Just like the computer always knows what the right move is. Trading unusual option activity is different. It's like playing a game of poker. The best poker players in the world always end up with all the money. Poker is a game of probability, but the best players always end up with the most money. Okay? Here's a picture of Phil Ivey. I consider him probably the best poker player in the world. Does he lose money in a day, a week, a month? Yes. Just like talking, this is not a holy grail system. Okay? You will have trades that are losers. Not every single trade is going to be a winner. So you got to take some losses sometimes. Not every trade is going to make you money. So poker is a game of probability, math, reading other players. This is very similar to unusual option activity. We will never know if a trader has a stock position on against their option position. But using the trading plan I'm going to teach you guys today, you will have a better gauge to know if they do. Okay? I've taught this to so many people. We have 15 proprietary-based courses. This is the #1 selling course. Hands down, bar none. And the reason for that is because this is how I trade every single day. Let's get a picture of Phil Ivey too. So here is your secret sauce. Okay, my grandmother used to make these cookies. And my grandma was an unbelievable cook. I guess it should be a chef. And really a pastry chef. And I used to say to her all the time, I'm like, Grandma, how are they so good? And she had the recipe, but she would never tell us. She's like, you put this much sugar, and then she'd always eyeball it. You know, you put all this much sugar in, put this much salt, this much butter, this much flour. I was like, okay, but like this isn't really getting me to where I need to get to. Can you write it down for me? She goes, why would I have to write it down? I have it memorized. I used to have a sales guy in my office, and he said, AK, if I could just take everything out of your brain and just spit it out, it'd be amazing. Well, like, why don't we start teaching courses of how I can teach people how I trade? Okay. The next slide, besides the slide at the end where you guys can participate in the boot camp, is probably the most important slide. I would take a picture of this immediately. This is my proprietary base trading plan that I'm sharing with you guys today. This is known as the Oak Ribbit Trading Plan. OCRRBTT. The Oak Ribbit Trading Plan. Okay? The first thing I look at is option volume versus open interest. Option volume versus open interest. I always want to make sure that the volume is greater than open interest. Volume is how many options trade today. Open interest is how many options existed before today. If you guys are trading think or swim like myself, it's very, very easy to get. So let's say I can go to Bristol Myers, and I can add this category or column here. So let me just show you how to do this. Okay. So what you do is you go in here, and you hit the little custom or layout. Layout. So you hit layout here, and then you go to custom. See that custom, guys? Then on the left, you have all these different things you can add. So what you'll do here is you go down to the bottom, you hit volume, and you add. Go up to open interest, and you add. Okay, you hit OK. There was a trade today in Fossil, and we see the volume was 4,000. The open interest was 174. So 4,102 Fossil May 15s traded today. The open interest was 174. So that is the first thing I always look at. Volume greater than open interest. I always want to make sure that the volume is greater than open interest. Then I want to look at the chart. If there's a bullish chart, I want to make sure that, and if there's call activity, I want to make sure it's a bullish chart. If there's put activity, I want to make sure there's a bearish chart. So I use the Ichimoku cloud. You can use any kind of technical analysis method that you want, but I always want to make sure that it lines up accordingly. Then R and R, and this is something we're going to teach you guys that is so important in your trading, your risk versus reward setup. A lot of you guys are probably not making money because you're not taking proper reward to risk setup. Okay, you sell it. You know, there's people in the industry that talk about selling call spreads for 10 cents. Okay, why would I sell a call spread and risk 90 cents to make 10 cents? Yes, I have a good probability it goes to zero. But if you start trading spreads with no catalyst, guys, you're going to lose your money on commissions. You're just going to lose money. I've seen people teach iron condors and SPX. They have a third, this trade makes money 2/3 of the time. Yeah, but the 1/3 of the time you lose all your money. Okay, reward to risk setup. Some people like rest and relaxation, but I like reward to risk setups. B stands for break even. What is your break even on expiration? For calls, it's strike plus the price paid. For puts, it's a strike minus the price paid. Then we have TMT. This stands for time and target. Okay, this is really important in your trading, guys. And we're going to teach you guys in the boot camp how you can maximize your exit strategies by using something called standard deviation ATRs and ATRs. If you didn't understand that, that's completely fine. We're going to teach you that in the boot camp. Okay? We're going to teach you guys how you can figure it out using standard deviation ATRs and ATRs combined with the delta. So those time and targets. So really here we're going to teach you a much more elaborate version of these two and these two in the boot camp. This is a very good overview you guys can use. You can print it out. You can take a picture of it. A lot of my traders have a piece of tape on the side. But the R&R and the TNT, which are the most important things, this is something we're going to teach you guys in the boot camp, how you can figure both those out. Okay, so let's talk about option volume versus open interest. Volume are how many options are traded today. Okay, so an example in Fossil, there's over 4,000 options traded today. Open interest are how many exist before today. So we always want to make sure the volume is greater than open interest. So how many options traded today is greater than how many exist. If volume is less than open interest, a lot of times I won't take a trade. Simple and easy. Then charts, okay? If calls are being bought on a 52-week low, a lot of times I think they're buying calls against a short stock position. Because remember, guys, we don't always know a trader's stock position. If they're buying puts on a 52-week high, then a lot of times I think that they're buying puts as protection against a long stock position. So you got to always make sure the chart lines up. What are a couple really good tools? Higher highs, higher lows. I use the Ichimoku Cloud. I teach my beginner traders to not take any trades, any bullish trades that are below the cloud. There's a Bristol Myers trade. If you're a beginner, maybe you steer away from that. Or not take any bearish trades above the cloud. So always make sure the chart lines up in your trading is so, so important. Keeps you away from a lot of really, really bad trades. So here's an example of this is MRO. This was from a while ago. So this is a clear bull channel, higher highs, higher lows. If I see puts being bought in here, I would say they're probably buying puts against a long stock position. If I see them buying calls over here in this bear channel, I would say they're probably buying calls against a short stock position. Remember, guys, we're never going to know a trader's stock position. We can surmise and guess by going through the Oak Ribbon trading plan. Okay, volume, chart, and then R&R and TNT is going to teach us something in the workshop. Okay, so make sure the chart lines up with the institutional order flow that you see. Then we have R&R. Some people like rest and relaxation. I'm not a big person of rest and relaxation. I'm in San Diego right now, and I was just like, wow, I forgot how boring San Diego is. There's nothing to do. So risk versus reward setup. We're going to talk about this more in depth in the boot camp. As a generalization, good traders think about how much money they can make. I'm not a good trader. I consider myself a great trader. I say, if I am wrong, how much money can I lose? Okay. Every single trade setup. I took a trade in Apple today. I had $300 of risk. 300 could turn into 1,500. But I'm always looking at my risk versus reward setup. Paul Tudor Jones is probably the best trader in the world. Always talked about a 3 to 4 reward to risk setup in trading. I wouldn't say I'd go for that. I go for things that are at least 1 to 1. Break even, we kind of went over that. And then time and target. And this is something I'm going to teach you guys in the boot camp because every option is different. If you're trading weekly options, those have high gamma, high theta, high risk, high reward. Okay. If you're trading longer dated options, you can give those puppies a long time. So just take that in consideration. Your R&R. Risk versus reward is so important, and your time and target. Okay, we're going to give you a better idea of time and target in the boot camp, and I'm going to teach you this methodology for proprietary-based exit strategies, which is really going to help you expand how much you're going to get for an option. Okay. Target, weekly options. If you're trading the weekly options, I'm out of every weekly option by the end of the day, and this is because I've had a lot of trades that I've lost a lot of money on trading weekly options. Weekly options are like the hardest thing to trade because the gamma is so high, the theta is so high, and the vega is so high. So it's really, really hard to trade these weekly options. So I'd rather do something that's not going to have so much risk and so much reward. Because I lost a lot of money in weekly options. So be very, very careful, guys, in those weeklies. Okay, you say this AK sounds great, makes sense. I understand the Oak Ribbit trading plan, but why should I take these trades? Well, the hedge funds and bigger traders have more information than us. That is why they're always getting in trouble for insider information. Okay? Just watch an episode of Billions and you realize why the institutions have information that we do not have. Okay? They have information to research, technology, basically they're on the inside. So imagine knowing, hypothetically speaking, Carl Icahn or David Einhorn's position before they are disclosed to the public. Some of these trades, we don't know which ones, will be Carl Icahn's positions. Some of these trades, we don't know which one, will be David Einhorn's positions. Okay? We never know which one is their position, but these are their positions. Okay? We know this. I mean, because Bill Ackman had a big Herbalife position, and you could see the open interest of the puts was like 30,000. And then if you go on the back end and look, you can actually see, you have to look at the filings, but you can see that it was, probably his. You can see it's probably mostly his. Okay. So, summary and key takeaways before we get into some examples, and I'll show you how one trade last week, guys, I made over $8,000 profit. So, reading paper does have its limitations, and this is not a holy grail system, guys. I'm not going to sit here and say, hey, this is a holy grail system. You should take every trade. You're going to make $1 million. It's just not possible. This is not a holy grail system. Call buying is not always bullish. Sometimes they're buying calls and they have a short stock position on against it. Buying puts is not always bearish. Sometimes they have a long stock on against their long puts. Bulls can't bluff selling puts. So selling puts is a very, very good idea. Large paper and unusual volume will help put probability and math in your favor. Because you're mimicking what smart paper is doing. Okay, remember, paper is in order from a hedge fund, mutual fund, retail bank, or a big trader. No trading plan or trading system is without losses. If somebody ever sells you a holy grail system, start running immediately. Okay, there's a lot of people in the industry that will put on stuff on social media. Every day they show an account where they make money. Well, hypothetically speaking, if I had two accounts and I made $500 in one account, I have the exact same position in another account, I lost $500, it would be very easy for me to shoot a video and show you that I made money in my account. Because I'm going to make money in one account and lose money in another, and then social media, they'll just show the one account that makes money. So be very, very careful of stuff you see on social media out there. Understanding that losses are forever a part of trading and that controlling risk is the most important thing. Managing profits is second. Objective in your trading. Okay? With this said, let's go over some examples of institutional order flow that I've seen in the last month that if you took these trades, you could have profited 100 to 500%. In 1 second. How I made almost $5.5 million. Watch the hedge fund trades, mimic their positions. I made it close to $1 million in Apple for 2 straight years. I am a very active trader. I have traded over 1 million equity options in my trading career and 40 million shares of stock, never on a group P&L. So, I mean, like group P&L would be like, Wolverine, Susquehanna, Citadel. Those kind of firms do group P&Ls because they hedge the basket against other stuff, CTC. I basically have never done that. Okay, I trade on my own account. I did have a backer, so I had to give them a percentage of the profits, but I've been trading on my own account since my days at Boda, to be completely honest. Okay, the Oak Ribbit the unusual option activity course, you'll learn the Oak Rivet trading plan in much more depth. Why volume versus open interest matters so much. We'll teach you how to dissect the whole option trade, because you have to be looking for out of the money open interest and in the money open interest. Why I mimic the hedge funds. Different setups for different traders. Okay, I have some traders that say, AK, thanks for telling me there's a call buyer. I don't want to buy calls though. I want to sell credit put spreads. Well, that's fine. I'm going to teach you guys how you can do that. You can turn it into a call butterfly as well. Why stock volume is so important versus option volume. Figuring out exit strategies for Andrew Keen's no blowout trading plan. How I determine which trades I risk the most money. So I have a trading plan. It's called the confidence scale. And then we're also going to teach you that strategy of figuring out proprietary-based targets. And we're also going to teach you how to basically figure out which trades are the best a little bit more in depth. So now that that has all been said, let's talk about a couple examples. This is the first trade, okay, that I saw going across the tape. A trader somewhere in the world, no idea who the person was, could be grandma in Oklahoma, bought DKS, March, 32 calls for 75 cents. And I kind of flagged right here where they are. Okay. The stock was right here. It was actually the day of earnings that an institution bought calls. So somewhere in the world bought DKS, March 32 calls for 75 cents. These went to $4. So hypothetically speaking, let's say you bought 10 of these. 10 lot, guys. Sure, a lot of you guys here are trading 10 options. Okay? If you bought a 10 lot for 75 cents because you saw basically institution order flow, you went through the Oak Rivet trading plan, you noticed the volume was greater than open interest, you knew the chart looked good, you took this trade. So you bought 10 at 75 cents. Let's say you used a 50% stop loss. Your stop loss was 40 cents. Okay? You're risking $350 on this trade. Okay? So if you use a stop loss here in DKS and you bought these for 75 cents and you put a stop loss in place, okay, those options within 2 days, okay, you would have never gotten stopped on the trade, went to $4. So your 10 lot that you were risking $350 went to $4,000. Okay? How does that sound for a trade for you? Not bad, huh? On just a 10 lot. But so those options went from 75 cents to $4. How did this trader know that DIX was going to magically turn around on earnings, reverse, close on the highs, break the cloud to the upside, and continue higher? No idea. Sometimes I don't know how they know it, but they do know it. Okay? So this trade, guys, you're going to risk $350 and you would have made, that would have turned into $4,000. Next trade, on 3/13, a trader bought Citi, okay, Citigroup, the March 74.5 puts for 29 cents. Was volume greater than open interest? The answer is yes. Second question you ask, is the chart bearish? Well, right here, you can see it's breaking the cloud to the downside. I'm a big Ichimoku cloud breakout trader. It's breaking the cloud to the downside, so yes, the chart is bearish. So you then say to yourself, should I take this trade? Hey, maybe I'll take a 20 lot of these. Okay? Let's say I took 20 of these for 29 cents. And I put a 10-cent stop loss. 10-cent stop loss. So I'm risking 19 cents on 20 options. I'm assuming most of you here can risk $400 on a trade. Maybe you can. Maybe you can risk $40. That $400 within 2 days would have gone to $3,000. Okay? Because these puts then went up 500% or 150%. And look what the stock did, guys. It went from 76.5 to 73.5. So that's only about, what, 5% to the downside? 5% to the downside, and the puts are at 500%. Well, how can it do that? Well, it can do that because it's huge, huge gamma. Huge gamma means high risk. Huge gamma also means high reward. But if you put a stop loss at 10 cents, these could have got you, you could have been risking about, so you risked $300. You risk $300 on this trade. $400, 19 cents into 20 is 380. So you risk 380, that 380 would have turned into $4,000. Next one, U.S. Steel, okay? Have you seen the U.S. Steel lately? Ew, ugly, okay? On 3/8/2018, a trader bought U.S. Steel March 39 puts for 22 cents, okay? This one was a little bit harder because it wasn't breaking the cloud to the downside, but if you guys know technical analysis at all, you can see this is consolidation. 1, 2, 3, triple top, big tails on top, okay? So there's a good chance it could sell off. Well, these puts on the March 39 puts went from 22 cents to $1.50. Let's say you put 20 of these, and let's say you didn't use a stop loss. Maybe you're not going to use a stop loss on a 22-cent option. Probably not going to put a stop loss at 10 cents. And the option is only 22 cents. So let's say you bought it at 22 cents. 8 days later, if you held this trade, this would have turned into $3,000. Okay? And I could sit here and I could go through 10, 20, 30, 50, probably 100 examples of trades that are profitable. I could also show you trades that are losers because this isn't a holy grail system, guys. I'm not going to sit here and say you're going to make money on every single trade because the fact of the matter is you're not. You're going to have some times where you lose money. I am personally up about $50,000 in the last 6 weeks trading like this. That's not bad, is it? Remember, guys, if you can make $500 a day, that's equivalent to $132,000. There's 262 trading days in a year. Okay? You guys have tried everything before in the past. Now try something new. Maybe something you're a little bit more uncomfortable with. Because this is a little bit more hard and challenging. And this is why we're going to give you guys a 2 to 3 hour boot camp so you can learn it more in depth. Here's another one. And this, coincidentally, just like Dick's, was a trade on earnings. Okay, the day after earnings it's very volatile days. You know, Apple got up to 175. Where Apple closes, I don't know. If you looked at Amazon, I mean, Amazon got up to, what did Amazon get up to? If you look at Amazon and earnings, it was crazy what it did. The day after earnings is a lot of volatility. Amazon got up to 1638. It's down, what's I down $50 since then? It was up 16 today. 16.38, and it sold off almost $100 that day. Crazy. So an institution somewhere in the world bought CTRP, March 49 calls, and I know some of my students bought these calls. Why? I taught them the trading plan. That was on the day after earnings. The after earnings volatility is also very, very low. Okay? So, institution bought CTRP, March 49 calls for 20 cents. That day, I repeat, that day, those calls traded up to $1.20. Okay? If you would have taken those, you could have made 600% returns that day. There is basically nowhere in the world you're going to get 600% return in an option unless you're watching institutional order flow. You can get it in penny stocks, but good luck trading penny stocks. These are really, really hard. So these calls went from 20 cents to $1.20 that day. That is a 600% return, guys. Okay? And these are just some of the examples from today. Like I said, I'm up, I think, about $43,000 in like the last 6 weeks or something like that. trading this exact same strategy and philosophy. Okay, last one I'm going to show you here, guys, in Alibaba. I'm sure a lot of you guys like to trade Baba. I love trading Alibaba. Institutions somewhere in the world bought Alibaba, B-A-B-A, March 200 calls for 25 cents. These traded to $2 the next day. Okay, so volume was greater than open interest. Chart, breaking the cloud again. Gap higher the next day. If you bought 10 of these, that 25 cents went to $2,000. Do you need a monthly subscription to get this into activity? No, because what I'm going to teach you guys in the course, everything you're going to need to do, and then we're going to give you how you can, a mentoring session of how you can find this on the scan. Okay. So you don't need a subscription for that. Okay, here's an example, guys. This happened just on Thursday. A lot of my subscribers that bought the course got this trade. I'll show you what happened to me in this trade. I made about $8,000 in this trade. This was from Thursday, so a lot of those examples were from March. Institution bought 2,500 CIEN, March 25th. 26 calls for 63 cents. Stock was trading 25.20. What do I look at? You've gone through your trading plan. Volume, greater than open interest. Chart, looked like it was going to reverse. It was on a big down day. Then, I decided to buy these. Let's see what happened that day, guys. This is my profits in CIEN that on Thursday, guys. This is timestamp. This is dated, and this is real money, and this is all my own. CIEN, I made $8,410. And this is not from 2006. This is not from 2005. This is from last Thursday, guys. Okay? If I can do this, I can teach you guys how you can do it. So, we have a course that we are offering you guys today. You can get in for $97. Okay, we only have 25 of these, and I'm going to throw in a bunch of bonuses as well. This is the Unusual Option Activity Trader Workshop. Okay, Unusual Option Activity Trader Workshop. It is going to be live. And what we're going to teach you are the following. How to dissect the whole option chain for your best results. Master proprietary-based exit strategies for trading options. It is really cool what I'm going to teach you. There's standard deviation, ATR, and ATR times the delta. How to add to losing a positions. Because you're not going to be really adding to losing positions that much. How you can learn a confidence scale and avoid blowing out. Okay? You guys, we have 25 spots. John is in. Jasper is in. Brian is in. Make sure you guys sign up. It's optionsonthefloor.com/option. It's only $97. Jacob is in. Brian is in. Eli is in. Dominic is in. Margaret is in. Oh, we got a female in here. Okay. So this is a course we're going to do for you guys live. Yes, you can do this. Bernard Hill is in. You said yes. If you're not a full-time trader, you can still learn this course. Okay. Plus, we're going to throw in 2 bonuses for you guys sitting through this workshop. Bonus number 1, I'm going to give you a cheat sheet of every single stock I've traded this year with all my winners and all my losers. So you'll know which one is the best. Yes, it'll be recorded. Elisa's in. So we're going to throw in a cheat sheet, guys. We're also going to throw in a Thinkorswim tool where you cannot get anywhere else. This is called the high-low tool. Basically, the high of the day and the low of the day is plotted in your charts to help you figure out proprietary-based targets. You get in, Kelly, at optionsonthefloor.com/option. Optionsonthefloor.com/option is where you can get in. So this is the unusual option activity workshop live. Can I analyze this after hours? Yes, you can. Any questions? Just fire out questions, guys. A lot of people taking advantage of this signing up already. So this is an unusual option activity course. We've sold more of these than anything else. Okay, so this we sell for $499 right here. This is the Thinkorswim high-low tool. We're throwing this in for the bonus for the first 25 people. If you're not in the first 25, you're not going to get this as bonus. We're throwing a proprietary-based cheat sheet. This is every single trade I've made money on and lost money on this year. So that's $199. That's $499. And the course, you can go to our website. We sell for $999. So this is $1,700 of value, guys. We're going to give you for only $97. I usually try to do 10 times your return on these kind of promotions, but for this, I'm going to give you 17 times your what you're putting in. Okay, I usually try to get 10 times. So what this is, guys, this is your unusual option activity trader workshop. Okay, we have close to about 150 people in here. This is what you're going to get. How to dissect the whole option chain. Master the best possible exits using your standard deviation ATR and your ATR, which is the best way to figure out your exits. Also, how to add losing positions, if some people like to add losing positions. Learn a confidence scale and avoid blowing out. Plus, we're going to throw in 2 bonuses, a cheat sheet of every stock I made money on this year, plus a Thinkorswim high-low tool of the day. It is a total of $1,700. We're giving it to you guys for $99 today. And we only have 25 spots available. Okay, after that, we will sell out. Like I said, we have about 150 people in there. I'm looking at my inbox. Jennifer is in. Laura is in. Paul is in. Chelsea is in. Jacob is in. Melissa is in. We got about 8 spots left, guys. So make sure you guys sign up. optionsonthefloor.com/option. So it's optionsonthefloor/option. When does it work? Charles is in. The workshop date, I'm not 100% sure, but I know you guys will get the recording. Okay, I know you will get the recording as well. Max, you're in. Pavel, keep trying. You'll get in. Okay. This is a live workshop. Yes, it is a 3-hour live workshop. I get winded. I'm actually winded after this right now. Yeah. So I'm actually pretty winded right now. Okay. So what we have 25 spots. Okay. 25 spots available. We've sold a ton, guys. We have a couple left. You cannot call anybody no. Cannot call anybody no. It's just optionsonthefloor.com/option. Okay. This is the unusual option activity trader workshop. It is live plus recording. Okay. We're going to give you guys 2 bonuses if you sign up and are in the first 25 people. The first one is a cheat sheet. I will actually show you what the cheat sheet looks like. So this is what the cheat sheet looks like. It will help you decide which unusual option activity trades you want to take. So I've actually went even further. And I've done day trades, winners, day trade losers, unusual option activity winners, and unusual option activity losers, and then earnings winners and earnings losers. And I can actually add a couple to this one. This will be McDonald's was a loser. McDonald's, Apple most likely will be a winner. And Allergan was a loser. So this will tell you, so a lot of my subscribers that take the course, what they'll do is they'll print this out and put this right next to their Oak Ribbon trading plan. So I know if I see an option in Melco, I'm not going to take a trade because I've lost money before. I don't try to take trades that have lost money before. Okay? So this is so important in your trading, guys. You know, someone sent me an email one time. They're like, hey, Kate, can I trade this on a 1-minute bar? I was like, yeah, you can trade on a 1-minute bar. I signed up before but didn't get anyone to teach the course. We taught the course last Saturday. We did teach a course last Saturday. And we're going to do another one. Okay? So let me talk about what you guys get. If you're one of the first 25 people, guys, I'm going to give you 2 bonuses. Kelly, you got in. Nice. So we're also throwing in 2 bonuses. Bonus 1 is our proprietary-based cheat sheet. I'm actually going to throw in a 3rd bonus, too, if you sign up today. Okay? Pete, you're in. Okay? Okay. What I'm also going to give you guys is another bonus. We'll give it after the course because it's kind of hard to give it before the course. It is a top 10 tips and tricks for trading unusual option activity. Okay? So if you guys sign up, I'm going to throw this in for you guys for you guys as well. Maurice is in. Pete is in. Okay? So I'm throwing in 3 bonuses today if you sign up. So you're going to get the cheat sheet. That's a $199 value. You're going to get a Thinkorswim proprietary-based tool that plots out the high and low of the day. This is something we created on Thinkorswim. Plus, you're going to get the course live and recorded. So these are $499, $199, and $999. And I'm going to throw in bonus 3 after the course, because I can't send it before because it wouldn't really make sense. And this would be a tips and tricks. Okay? So this will be another $199. Usually, guys, I try to give you guys, you know, basically 10 times your capital on my products. I'm going to give you 19 times your capital on your products. So $97, guys. If you cannot afford $97, you probably shouldn't be trading. I'll be completely honest with you. Okay? You probably shouldn't be trading. So the course will be live and on demand. Okay? It'll be 2 to 3 hours long. And these are the 3 bonuses I'm going to throw in for you guys. Okay? The cheat sheet, $199. The Thinkorswim proprietary-based tool, $499. Number 3, bonus tips and tricks. We'll give you guys that one afterwards, $199. Plus, you're still going to get the unusual option activity workshop, guys. And this is live. It's going to be 3 hours long. Is there a scan? We're going to do a mentoring session, so I'll show you guys how to scan in Thinkorswim. Yes. I have to learn it first, but yes, you'll get that. So what you'll learn in the course is how to dissect the whole option chain, master the best possible exits, how to add to a losing position, learn a confidence scale, and avoid blowing out. So we've talked about the Oak River trading plan. The thing that's going to help you the most is the RNR and TNT. Okay, I'm going to teach you guys a confidence scale of how you can, you know, yes, you'll get the replay, Kelly. How basically you're going to have a confidence scale. Plus, what I'll also do for you guys is I'll teach you guys this exit strategy that I've been using in my trading. And the exit strategy is also we're going to teach you the standard deviation ATR and the ATR. Okay, so that's it. Simple, nothing, guys. Make sure you signed up. John, you're going to have to email support@tradethirsty.com. Thank you, Kelly, Greg, Hannah, Paul, Pete. And now we're going to do some technical analysis. Okay, so this is a $1,700 value, guys. Okay, and it's going to be live plus recorded. So you get both of these. Okay, if you guys have any charts, fire some charts in here and I can dissect this. I used to do this thing called lightning round where I'd go through like a bajillion charts. We'll teach you how to scan on Thinkorswim. Andrew, welcome to the program. That's a really good name. Caesar, Maurice, David, Maxon. Okay, so I'm going to leave the link here. It's optionsonthefloor.com/option. So what we'll do here, guys, all you have to do is spit out a stock, and I'll tell you bullish, bearish, or neutral where to get into the stock. So give me any stock and just fire away. I? Is that an L? Looks like an I. Hold on. I have to set up my chart here. I need the ticker. I know FedEx is FedEx. FedEx. Ooh, FedEx. Breaking the cloud to the downside. I will look for a break of the cloud to the upside here in FedEx, and I look to get long FedEx above 250 with the stop under 240. I wouldn't buy FedEx until it starts showing bullish action, but I'd like to get long at above 250. EA, this actually one had a really weak earnings. EA is under the Ichimoku cloud here. I would look for a break of the cloud to the upside. I look to buy buying above 125, but I wouldn't buy until it did break 125. So FedEx and EA wouldn't take it till it broke the cloud to the upside. Google had really, really weak earnings. Consolidation now. It's in a kind of a trend down here. I would wait for a break around 1120. I is a ticker. Okay, I'll bring up I. 326 today. I'd be looking to buy any pullback here. So I'd be looking for a pullback here in I. If it pulls back to 10, buy it. If you wanted to buy it today, your stop would be under 10. But I think I is a buy and a pullback. Johnson & Johnson. This one's really weak. I'd be looking to short Johnson on any rally. It can't get under this 125 level is really big. And look at that 122.50 level is really big here. I'd rather be short than long Johnson & Johnson. I mean, if you wanted to buy it and stop under 122.15, I think it's okay. Consolidation, we'd rather be short than long. Schlumberger in the cloud here. So Schlumber, I'd rather buy it breaking that. I'd buy it as it broke the cloud to the upside above 72. I wouldn't want to buy it above 72. Workday, I remember my brother told me to buy Workday so long ago. Workday, if it breaks the cloud to the upside. So a lot of these charts are in the cloud or below the cloud. I'd be looking to buy above the cloud here. So Workday, I would be looking to buy it above the cloud. I don't want to buy it in the cloud here. So Workday here. OC, Orange County. Orange Coin. Probably had bad earnings here. OC, under the cloud here. So I wouldn't take OC here. It's very, very weak. I'd rather be shorting it on any rally up to 80 than buying it. Chevron. We'll do these for about 2 minutes of charge, guys. We'll talk about what we have to offer, and then we'll call it a day. Chevron, I like it here. Pulled back a little bit here. I think Chevron goes higher. I think Chevron breaks 130. I'm looking to pull back to 122. So Chevron, I like it. I like it like that. Baby, I like it like that. I like it like that. RTN. RTN just broke the cloud to the downside. I would buy RTN if it broke the cloud to the upside. It's bullish on the 2-day, the 3-day. Actually, the 2-day is neutral. 3 days bullish. The weekly is bullish. I'd buy a breakout above 213. I wouldn't buy it until then. Apple, where'd Apple close? I'm long Apple. I wanted to sit at 175, close at 175.23. CIEN, you have the stock that I made $8,000 on. That had a huge reversal today as well. Reversed. It's above the cloud again here, so I think CIEN breaks here to the upside. So I think CIEN looks good, and I think it breaks to the upside. So let's go back and talk about it one more time, guys. Before I ever hold your peace, if you sign up today, I will give you all these bonuses. We're throwing in 3 bonuses. Bonus number 1 is a cheat sheet. This is a $199 value. Okay. Bonus 2, we're going to throw in a proprietary-based thinkorswim tool. Okay. This is a high-low tool. It'll plot the high of the day and the low of the day. It helps you with your exit strategies. We'll throw that in. That is a $499 value. We're also going to throw it after the course, so you will not get that now. We're going to throw in tips and tricks. This is another thing that is, it gives you top 10 tips and tricks for unusual option activity. That's a $199 value. And plus the course. The course, guys, I'll show you actually the course on the website before we go. This is a $999 value. Okay. We saw it on the website for $999. So you're getting 20 times your capital, so it is about 95% off. What you'll learn in the course is how to dissect the whole option chain, master the best possible exit strategies, how to add to a losing position if you did want to lose any position, confidence scale. It is live and recorded, guys. So it is live and recorded. And the link is optionsonthefloor.com/option. Optionsonthefloor.com/option. And I can actually just show you this one at a time before we go. You can see here, look at this, guys. It is on our website. It's $999, and you don't even get the live course for that. You just get the on-demand. So you get this on-demand. Okay, optionsonthefloor.com/option. Everybody have a great, great night. Thank you. I'll see you guys in the course. If I don't see you in the trading room tomorrow. John, you have to email them. I told you. You have to email them. Support@Trade Thursday. Because I actually don't take the processing. So you got to do that. All right, everybody have a great night. Thanks. I'll see everybody in the course.